Welcome to Alpha Insights. I'm Tyler. Markets are open today, and we've got a big headline to unpack. Joining me is Jonathan, market analyst. Jonathan, great to have you here. And hey, listeners, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks, Tyler. Good to be here.
All right, so here's the gist. There's a report tying a $16 billion warning to 5 of the biggest tech names. Can you explain what that actually means in plain language?
Sure. At headline level, the story says people close to very large firms, companies valued at $2 trillion and up, are signaling caution. And the headline ties that to $16 billion connected to 5 names: Nvidia, Apple, Alphabet, Amazon, and Microsoft. But the report doesn't lay out a company-by-company breakdown or the exact mechanism behind the figure.
So the number is big, the names are big, but the detail is light. How should listeners think about that gap between headline and detail?
That's the crux. Headlines like this can move markets even when the underlying data is thin. There are 3 main risks to keep in mind: an information gap, where rumors amplify moves; concentration risk, because these 5 firms make up a large chunk of mini portfolios and indexes; and liquidity or volatility risk, if large holders shift allocations quickly.
Right.
So, the real question here is whether the $16 billion represents a coordinated sell, a set of position trims, or just a headline-friendly estimate. Without filings or public notices, it's hard to know.
Okay, walk me through practical implications. Say I'm a listener with exposure to these names through an index fund or a growth portfolio. What changes, if anything?
First, don't panic. Analysts note that headline-driven volatility is common. That said, the possible implications are clear. If large institutional holders begin rebalancing, passive funds can experience forced flows, creating short-term pressure on these stocks and on funds that track major indexes. Traders might see wider bid-ask spreads and bigger intraday moves. For individual investors, this raises the importance of position sizing and risk limits.
I mean, when you look at the data, what should people actually monitor right now?
Watch a few things closely. Company disclosures or regulatory filings that could reveal large trades. Any public commentary from the companies themselves. Index or ETF rebalancing announcements. And market metrics like trading volume and implied volatility in options. Those will tell you if this is noise or if real flows are underway.
Interesting.
Another point, the report didn't show how the $16 billion is allocated across the 5 companies. It could be concentrated in one name or spread across all 5. That unknown is why markets can overreact before confirmatory data arrives.
So what's a reasonable near-term scenario versus a more serious one?
A reasonable near-term scenario is headline-driven selling that peters out once follow-up reporting fails to show a material shift. A more serious scenario is that large holders actually execute reallocations, which would increase volatility and could pressure related exchange-traded funds and benchmarks. The key difference is whether the $16 billion translates into actual executed trades. Honestly, I was a bit surprised by how quickly the story picked up traction. That's a reminder that market psychology can amplify sparse information, especially around megacap names.
All right, for investors who want to be proactive without making knee-jerk moves, what are sensible risk management steps?
Review position sizes relative to your risk limits. Check liquidity in the funds you hold, and consider stress testing scenarios where these names fall more than normal. Analysts often recommend updating stop-loss rules or rebalancing guidelines so decisions are systematic, not emotional. Importantly, none of that is personalized advice. It's general risk management language.
Got it. Any final thoughts on how this could affect broader market tone?
If institutional sentiment shifts meaningfully, it could widen volatility beyond these names, and affect index performance. But if follow-up reporting is thin, the market may absorb the headline without lasting damage. So keep an eye on the confirmatory signals we talked about.
Right, right.
And remember, short-term noise often looks bigger than the long-term fundamentals, especially with mega-cap firms that have deep investor bases.
Okay, before we go, let's give listeners 3 quick takeaways they can act on mentally today.
Sure.
First,
1. The $16 billion headline matters, but the lack of breakdown means treat it as a signal to monitor, not as a trigger for immediate overhaul.
2,
2. Check disclosures, index or ETF notices, and volume and volatility metrics to see if the warning becomes actionable.
3.
3. Use this as a prompt to review position sizes and risk rules, not as a reason to make emotional trades.
Great, and quick reactions.
Right.
Thanks for breaking that down, Jonathan. Listeners, if you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai.